Well, this next little video that I'm going to give you guys is one of the most important things I could ever teach you. And that is what causes stocks to go on sale. Now, the reason this is so important is because there's a huge number of people who invest in the stock market, mostly your pension fund managers and hedge fund managers and mutual fund managers, insurance fund managers, who have been taught in business school that stocks never go on sale, that the value of the business is always the price of the stock. We don't think that's true. Warren Buffett doesn't think it's true, and the rest of the best investors in the world don't think it's true. We, in fact, think that the market can get very emotional and that sometimes Mr. Market puts things on sale that shouldn't go on sale. Now, why would that ever happen? Because think about it. The guys that control the market are managing all of this little guy money, right? They control about 85% of the money in the market. They're very rational guys. They went out there and they were the valedictorian of their high school. They were the #1 graduate out of Harvard. They went to Columbia and Wharton Business School. They graduated #1 there. Then they got into Goldman Sachs training program. And then they were the #1 guy there. And then they got their own fund at age 30 years old. So they're incredibly smart guys, way smarter than we will ever be. And why in the world would they ever put something on sale? Why would they sell it to us at the wrong price? Because we talk about going out and being able to buy $10 of value for $5. That's your basic Rule 1 strategy. Who would ever sell you a $10 bill for $5? Especially a guy who's at Harvard, right? Why would that ever happen? Well, here's why. Because when these guys have a fund, their investment strategy, almost all of them, I would say 99% of them, is to just be sure they're following the market. In other words, they are what is known as a momentum investor. A long-term hold for most of these fund managers is 3 months, not 5 years, okay? They're in it for a short-term gain on momentum. The stock's moving up, they join the parade, they get out, trying to get out at the top, and then they move to another stock that's going to move on. That's how almost all these guys invest, all right? So if that's how they're investing and the length of time they're going to be in a stock is 3 months, what do you think they're going to do if something happens to a company that's going to make it a bad investment for a year? In other words, let's say that, cotton prices start to go nuts because of the Arab Spring. Maybe they're not going to harvest the Egyptian cotton crop, so cotton prices go from 85 cents to $2. Well, the guys who own companies that depend on cotton prices to be low, like let's say a t-shirt company, those investors then look at this and say, oh my gosh, it's going to take over a year before cotton prices come down. I need to get out of this company. Even if there's nothing wrong with the company, it's just going to have a bad year. They bail out on it, and that company can go from $45 to $15 simply because there's no big buyers. They're all getting out on momentum. Well, we're a really small investor. We don't have to worry about our investors being momentum related. We can buy for the long term. So we can wait when we see something that's on sale because they've sold it off. It takes us just a few seconds to get in there. So this particular stock you can look at, take a look for yourself. It's Gildan, right? And the cotton prices happened, I think this is 2011, the cotton prices went to the moon. Gildan went on sale. We got to come in there and buy it at 16 bucks a share. Gildan went back to $50 a share just in the next year or two. So this is how we can take advantage of the fact that the big guys are momentum traders and we're long-term investors following rule number 1. Now, if you enjoyed this video, please subscribe to my channel and visit rule1investing.com for more content. Now go play.